Inventory errors. The inventory errors can result from overstatement and understatement of ending inventory due to the mistakes in the physical count or pricing or mistakes in recording purchase. If the error was founded in the same accounting periods when the error occurs, we should reverse the erroneous journal entry and make appropriate or correct journal entry. If the error was discovered in the subsequent accounting periods, the previous financial statements should be restated. Incorrect accounting balance are corrected by journal entries. In addition, the correction of retained earnings is reported as a prior period adjustment to the beginning balance in the statement of shareholders' equity. The company also needs to disclose the nature and impacts of error on the financial statements. An error in recording purchase or calculating ending inventory affects cost of goods sold, earnings, and the retained earnings. Beginning balance plus purchase subtract ending balance of inventory is cost of goods sold. If errors in the purchase and assume the ending balance of inventory is correct, so the error in the purchase will have impact on the cost of goods sold because of this equation. And the cost of goods sold will have impact on net income. And finally, in the retained earnings. If the purchase, beginning balance, inventory are all correct, there are errors in the ending balance of inventory. The cost of goods sold will also be misstated. The error will have impact on earnings and retained earnings. Actually, for inventory error, it has self-correction mechanism. If there's an overstatement in the ending inventory in 2023, because beginning balance are correct, purchase are correct, so overstatement in the ending inventory will result in the understatement in the cost of goods sold. Understatement in the cost of goods sold will result in overstatement in earnings. And finally, the retained earnings will be overstated. If this error was not corrected, the overstated ending balance in the ending inventory will become the beginning balance inventory in the next year. The beginning balance of inventory was overstated. If purchase are correct, ending balance of inventory are correct, so cost of goods sold will be overstated. Cost of goods sold overstatements will result in understatements in the earnings. And finally, the retained earnings will be understated. Over the 2 years window, the error actually is self-corrected. The reason is because this equation. There was an error, 800,000 overstatement of ending inventory. This is an overstatement of ending inventory in 2023. The ending inventory overstated by 800,000 in 2023. Because inventory overstated, cost of goods sold will be understated. Then net income, retained earnings, both are overstated. If the error was discovered in 2024, actually in the following year, we should make a reverse journal entry. We debit retained earnings, which was overstated, and credit inventory, which was overstated, to make this correction. If the error was discovered in 2025, which is 2 years later, we know the inventory system has the self-correction mechanism. So no correcting entry requires. But the company still need to disclose the details of the error and the impact. For example, the overstatement have impact on earnings, earnings per share, retained earnings, so on and so forth. We are given the information beginning balance, in 2024 was overstated by 49,000, and the ending balance was understated by 79,000. These errors were not discovered until 2025. So what's the impact on the cost of goods sold? To solve this problem, we need to use the equation beginning balance of inventory plus purchase equals to ending balance of inventory cost of goods sold. Beginning balance of inventory was overstated, 49,000. Purchase is correct. If the ending inventory is correct, the cost of goods sold will be overstated by 49. And if the ending inventory was overstated by 49, actually the cost of goods sold will be correct. However, in this example, the ending inventory was understated by 79. Therefore, the total impact on cost of goods sold will be overstated, the sum of 49 and 79, 128,000. The answer is B.